Are we heading for a rally in the markets and metals in the short term as land markets bounce? Hi everyone and welcome to Ainslie Insights, brought to you by ainslie.com.au, the home of Ainslie Bullion, Ainslie Crypto, Ainslie Wealth and the Gold and Silver Standard. Be sure to have a look. Today, welcome back, Drew. He's been talking about the land cycle a lot. People know him for that he's been looking at that. There's been a little bit of a short-term move there. You've been looking at that and saying, well, is this going to flow through into other markets? How does it all fit together? How are you going today, Drew?
Good, Chris. How are you?
Yeah, very good. Now, as I said, you've been looking at that and we have had a little bit of strength here. Now, when we look at this through multiple lenses, because we're looking at this all the time, this is about it's been about as hard as it's ever been for us, trying to pick what's coming next, because you've got a lot of mixed signals at the moment, and this has been one of them. Often when we have mixed signals, we sort of defer back to you on this and go, well, what is it? Because you just take that step back and look at the bigger cycle. But, is it really just a long-term versus short-term thing of where this confusion is coming from at the moment?
Yeah, that's certainly a big part of it. We've been tracking the land cycle for a while, and most recently we saw the recovery from the Trump tariff spill earlier this year was quite lackluster. And we've been keeping an eye out for a potential macro lower high in the land markets, while the S&P, in the meantime, has had a great recovery from that Trump tariff spill. It's put in new highs and it's just sort of continued on its rally. That's created a bit of a divergence between the land markets and stock markets, and that's a really clear early warning sign that the land cycle has peaked, and the clock is ticking before the stock markets put in their peak. And it's really relevant for precious metal investors because gold and silver continue on for a little bit longer. During the crash, you have a one-to-one correlation temporarily, but gold and silver recover very quickly, put in new highs, and then silver starts to outperform gold after the crash. So we've looked at this quite a few times. We've been tracking it in real time for the audience in terms of, that recovery from the Trump tariff spill. It basically pulled back a fair bit, and it was leaning quite heavily on its 50% level off the recovery, which was a cause for concern because a couple of weekly closes below that 50% level is what we were on the lookout for, because that's the early warning sign that recovery is now in a position of weakness. And once you break those lows from the Trump tariff spill on the land markets, you've got a macro low, lower high, and a lower low. So that divergence is then confirmed. This was sitting on a bit of a knife's edge a couple of weeks ago. And since then, however, we've seen a little bit of reprieve. So just wanted to provide an update with the chart because it broke below that 50% level and didn't really close much below that level. And then since then, it's had a strong move up. So it's a little bit in no man's land, but it's gone from being on a complete knife's edge to looking a little bit more hopeful from that recovery. In the meantime, you're starting to see the US 10-year yields start to roll over. So that's the yields in long-term US government bonds. When bond yields go up, when bond yields go down, the bond collateral values go up. This is the blue chip collateral in the global financial system that people can, build debt on. So it's good for global liquidity. When the value of the collateral itself is increasing with the yields dropping off. The other thing is generally bond yields rolling over tend to coincide with an environment where the central bank can cut interest rates as well. And we'll look at that in a moment as well, where you can see the rate cut probabilities for the 10th of December meeting having really shot up. I mean, over the last couple of weeks, it's gone from like 20% to about 80%. And meanwhile, the volatility in the bond market continues to drop. So you've got the MOVE index that measures bond market volatility. When you've got less volatile assets as blue chip collateral, they're less risky. So there's less of a, sort of risk premium on these assets. So you can again raise more debt, increase the amount of global liquidity because there's less of a risk haircut that takes place on these assets. So you want low volatility and high collateral values for easy global liquidity conditions. So if you've got the DXY potentially rolling over as well, you've got the 10-year yield rolling over, you've got the rate cut probabilities moving up, and you're seeing a strong bounce in the land markets, well, that lends itself to a decent rally coming up for other assets as well. You can see risk appetite starting to come back into the Russell 2000. So, small cap stocks, which, shows a little bit more speculation, a little bit more of those animal spirits, if you will, in terms of investing. And you see, hard assets start to benefit from this as well. So you've got, the dollar value rolling over. Assets like Bitcoin and gold should have a rally in the short term at least. Now, where that rally leads to is unknown, because as much as we've seen a little bit of recovery in the land markets, it's still on a knife's edge. It's hard to sort of peel back the curtain a little bit further than the short term just at the moment. If you really zoom out, we know exactly where we are. We're close to a peak in that land cycle. But it's the midterm that's a little bit unclear. So in the short term, looking pretty positive. But we'll pull up a few charts as well, just to provide a bit more context of where we are.
And while you're pulling those charts up, it really is important, I think, for people to differentiate between the timeframes, because this is what gets people so often. They're investing for a long-term time horizon, but they've got short-term psychology around it. It is really important, because when you're talking about a bounce here, that's not saying now's the time to go, all in some of these assets, because you've highlighted we're towards the end of the cycle. we know that there are going to be breaks in the system coming. It's how nimble you can be, I suppose. You don't want to be investing thinking that, okay, I'm just going to set it and forget it now, unless you're going that longer term. But if you're going to do that, you can't be upset about a pullback. And if you do know that you're going to be a bit upset about a pullback, maybe you got to wait a little bit. It's very tricky right now. So I'm very keen to see these charts.
Yeah, it's such an important point. Time frame is everything. And if you're looking at gold and silver over 10 or 20 years, it makes absolutely no difference. You can basically just buy and average into the market when you've got the liquidity and just keep stacking. If you're looking at potentially selling some positions for the short to medium term, like you might need liquidity in the next 3 to 6 months, this rally, more than saying, I'm going to take advantage by buying now, it's more an opportunity to take some off the table so that you can buy more in 3 to 6 months or use that liquidity for whatever you might need. And then if you're looking, really, really short term, those are short term traders. I don't really get too involved in that sort of thing because it doesn't tend to be very profitable. I don't think there are too many profitable short term traders out there. But it's just good to know where we are, because when, you've got a long term view that we're coming to the end of a macro cycle and you're like, okay, well, it should go down from here. Quite often you see these moves up and they trap a lot of people because you think that, that you're going to just continue up endlessly. But when you have that expectation that it is going to go up in the short term, it doesn't really affect your long-term view because you sort of see it coming. So, first things first, I think, let's just look at the DXY, right? The DXY has been on a bit of a rally recently and hasn't really been great for hard assets. Just, Bitcoin specifically, I think, has been sort of paying the price for this a little bit. So, let me see if I can just get my cursor on the screen there. Beautiful. Alrighty. So the DXY has been putting in this uptrend. Basically, we did expect a bit of an air pocket in liquidity coming into August, September as well, and the DXY feeds into that a little bit. So you've had a peak early this year in the dollar index, and a strong move down. This has been really conducive to easy liquidity conditions, and then you've had a little bit of a move up here. Now you've lost the trend line, you've back tested it, so it does look a little bit like breakdown, retest, and possible resumption. This would form a left translated cycle for the DXY as well, and then downtrend here would just provide that little bit of reprieve for liquidity conditions. Hard assets like gold and silver should benefit. Bitcoin should possibly benefit from that as well. And that does tie into the expectations around rate cuts and the US bond market as well, because you can see here with the 10-year yields, you've had this consolidation for a while. Bond market's broken down, and again, retest and possible resumption on the US 10-year yields. Now, like we mentioned, lower yields equal higher collateral values, very liquidity positive, and it creates an environment where rate cuts are back on the table. So, if we were looking at the rate cut probabilities, this is a weekly chart. If you looked at the rate cut probabilities 2 weeks ago, they were much lower and the bond yields were higher. As the bond yields started dropping, those rate cut probabilities started increasing quite significantly as well. So, people are always looking at a whole host of different factors as to whether rate cuts are probable or possible, or what's going to influence the central banks. I think a way to cut out a lot of that noise is just keep an eye on the US bond markets, especially long-term bond yields. And that provides a little bit more of a clue as to rate cut probabilities.
And on the rate cuts specifically, I mean, there's a lot of expectation. I've had interesting conversations with Alex about this, and I think it was on one of the insights where she was saying quite categorically that if we can't be cutting rates here because of the inflation fears or the inflation that is coming. And I know you've got sort of talk of stimulus checks in the US, lots of things that are going to result in inflation, and whether the market is wrong here, whether that they're pricing in that one more rate cut might be correct, but after that, there's really not a lot of runway, and the inflation never really came down low enough. So I suppose that also feeds into this idea of short term versus long term, because we might get that this year, but that doesn't mean you can expect more of them ahead.
Yeah, the Fed is a little bit caught between a rock and a hard place. You do need lower interest rates for refinancing a lot of that government debt as well. Inflation has come down to 3%, and it's all about narrative, right? Because they've sort of been talking about how 2% is the target. Well, 3% is the new 2%. It used to be 2 quarters of negative GDP was a recession. Then they had that lady on TV a couple of years ago talking about how now we're not measuring it that way anymore. We have a different definition for what a recession is. So it's all just sort of narrative and smoke and mirrors. Who's to say 2% inflation is healthy? And who's it healthy for? So, they might change 2% to 3%. They could move the goalposts. Unemployment as well. Like, they haven't even been releasing data properly over the last couple of months. Yes. Well, they haven't released the inflation data. So, again, I don't want to get too down the conspiracy theory rabbit hole, but why haven't they released the inflation data? Does that give them a little bit more wiggle room to do what they need to do? So it's definitely something that, if they cut rates in the short term, inflation's basically baked into the cake. It's coming back whether we like it or not, and whether that's in the medium term or a little bit further down the track, when inflation comes back and you've got recessionary indicators, possibly as well, or high unemployment with that, which, might not be your typical recession, but it might be more to do with AI, it puts the Fed in a pretty tricky situation. So, it's very clear that they're not going to have the room to cut interest rates long term. I think that's very clear, and I fully agree with Alex on that. Short term, however, I think they want to, and they sort of need to for various reasons. The unemployment numbers have been ticking up, and they always talk about how the unemployment numbers are historically low, but if you look at any previous recession, there's always a steady increase of unemployment before a very significant, quite sudden acceleration. So if you look at any of the previous unemployment spikes, it's always these steady higher highs and higher lows before that acceleration. We've been in this lead-in phase for increasing unemployment for many months now. So I don't think that the employment market looks particularly good. And we've looked at that chart quite a few times with the S&P versus job openings, and you can see the divergence between the stock market moving up and job openings going down, which hasn't been the case. It's usually a one-to-one correlation, and that coincides perfectly with the mainstream release of AI products like sort of ChatGPT and that sort of thing. So I think AI is going to play a big part in putting the Fed in a difficult situation. AI in the long term is definitely deflationary, but in the short term, inflation is just too much money chasing after too few goods, and there's still so much money sloshing around the system from the COVID era that, we are going to enter a phase where we've got bad employment and high inflation. And I don't think that's anything close to where we are right now. It's definitely not in the short term. Maybe that'll be closer to, 2027 or 2028, but they are going to be in a situation where they can't cut interest rates unless they just massively move the goalposts. So we'll have a look at that when the time comes. But in the immediate term, we can see here the probability has gone up to about 85%. In my experience, it's 84.7. This has gone from about 30 to 80 percent chance of a rate cut in December's meeting. In my experience, anything over about 85% is basically a guarantee that that'll happen. So again, we're not quite there yet. It's 84.7. But if we see this move up to 85, 86, and closer to 90%, I'd say that's basically a guarantee that we're getting a rate cut in December. And, that really ties in, I think, to what's happening with the land markets as well. So this is what we were sort of the whole point of this recap is to have a look at this chart here. So this is the Trump tariff spill. The S&P recovered very strongly from here and put in, significantly new highs since. This is what we were concerned about. This looked all right initially. Maybe it would break up again. But when it hit this 50% level, we said, okay, well, it's still, kind of okay, but you want to see a strong bounce off it. When we got a kind of a lackluster bounce and, what looked like possibly a double bottom, we were still saying, okay, it's in a bit of a knife's edge. We need to keep a close eye on this here because multiple closes in this level show that this recovery uptrend is now in a position of weakness, and a break below these lows is that confirmed macro downtrend of a high, a low, a lower high, and then a lower low. A couple of weeks ago, we were doing a video when we were here and said, look, this looks like it could be breaking down. We need to keep an eye on it. Multiple weekly closes below this level, and we're basically keeping an eye on this level next for that breakdown. What's happened since then is we got a spike down, but a really strong move up, and we haven't really had those multiple weekly closes. So this is kind of looking okay now. It's again, and it's certainly not on a knife's edge, but it's in a little bit of no man's land. We could easily from here see a strong move up and a break of this high. Once we get a break of this high, then things are looking quite different. Then we've got a little bit more runway to work with at that stage. And, it's really something that we need to track on a weekly basis. So we'll continue keeping an eye on it, but I think the probabilities of rate cuts coming on the table, the 10-year rolling over, the DXY rolling over is all very supportive of the land markets and should be supportive of gold, silver, and potentially Bitcoin. In the short term, we should see a bit of a rally across all of these hard assets altogether.
And just on while that chart's there, that would be the argument the other way as well, that if it does move up, I suppose the next target you'd be looking at would be that high that's in there to see if it really bounces off that or makes a decent attempt at breaking through it, I suppose. Is that how you would look at it based on where we are right now?
Yeah, 100%. So all eyes are sort of on this level here, because if we just get a bit of a lower point there where it starts to run out of steam, you see, volume declining and smaller bars rolling over and breaks this 50% level here, then we're back to the concern that we were with a couple of weeks ago, which is that it is on a knife's edge. But the overall markets are looking okay. Like the Russell, for example, like I said before, is it's broken to new highs and looks like it's ready for a strong move up as well. So if risk appetite's starting to come back in, it is characteristic of the final stages of the land market. But this could chop around for a little bit, giving those other markets a little bit of time to run. So smaller market caps and more speculative investments as well. So let's just have a quick look at the Russell to see where it's at. And this was the move index before we bring the Russell up. That has been quite conducive as well. So that's, rolling over here, and you're getting that reduced bond market volatility, which is supportive of riskier investments as well. I think leading into the global financial crisis, went all the way down to sort of the 50s region. And, we've come quite a long way this year, all the way down from that 140. It's dropped, dropped by
So
half.
it has been getting much more stable.
Yeah, so it's looking quite good for liquidity from the bond markets. Let's have a look at the Russell to wrap up, because I think that paints quite a clear picture of risk appetite and, where some of these markets are. So this is the Russell over the entire liquidity cycle. The liquidity cycle really started, late 22, so around here. Sort of accumulating for a while, tested those all-time highs, and this was the Trump tariff spill. So, they've done incredibly well since that Trump tariff spill. I mean, they've done this entire move just over sort of 6 months. Continue all-time highs, bit of a pullback, and a strong move here. So we continue getting rate cuts, DXY rolling over, 10-year rolling over. In the short term, the Russell might put in, while other markets are putting in short-term rallies, the Russell could be putting in a bit of a blow-off. And again, all very characteristic of final stages of a cycle. And this is not something to get excited about. These are more cautionary signs, and they're more, points to find exit liquidity, not to become exit liquidity.
I think that's an excellent summary, actually, to pull it all together, that this idea of trading in the short term, you're lucky if you'll find anyone who's successful in that. I mean, people will be in the very short term, they'll have their wins, but it's not sustainable would be my advice. I would say stick away from that, and you can put that down as financial advice, because I've just seen too many people burnt and very few, or if any, been able to prove over a long time that they can trade short term. When you look at more of a medium term trade, that's where the real money is made, in my opinion. And really, that point you were just making, you just gave a very positive picture. You just painted a very positive picture, putting all those indicators together, suggesting we probably do get a rally here. But how are you going to use that rally? That's the important bit. And you're saying here, well, towards the end of this cycle, you use that rally as an opportunity to exit some position, lighten up on some positions. Your long-term stuff, sure, you can hold because, as you said, with gold and silver, over a 20-year time frame, looks like nothing. It's a blip when you zoom out. So for people holding that, but if you are trying to sort of time that a little bit to manage some of that volatility, the opportunity here is the exit, not the entry.
100% agree. So, I couldn't have said it better myself. If you're looking at a long-term time frame, it doesn't make sense to do anything. You can buy if you've got some liquidity. You can stack some dollars and do a larger purchase, once you get a bit of a pullback. However you want to play that in terms of your DCA approach. Everyone's got their own DCA approach. Some people will do it every month. Some people will do it once every quarter. Now, if you're looking at a short term, I would say don't look at short term. If you're looking at a midterm approach, then yes, lightening up a little bit, looking for that opportunity to then re-enter the markets is what these final stages are really for. Assets like gold and silver, I always say there's never really a great time to sell gold. If you zoom out far enough, any sort of blue chip assets, people that just don't sell and hold for the long term tend to do the best. I've heard so many stories of people talking about, I bought gold at a couple of $100, $300-400. It got to 900 and I felt so great and I sold it. And now gold's at and I'm talking about Aussie dollars, we're sitting at like 6.5. So, they sold for a 3x, which could have been like a 25x. So it's really just buying and holding and sitting on your hands, stopping yourself from doing too much. That tends to work. The main reason for sharing all of this is that when you do see a short-term rally, it just preps you for it so that in the larger context, land markets are still sort of in no man's land. We are towards the end of that cycle. You do expect a final peak in stocks and riskier assets. And then gold and silver tend to outperform moving forward as well, like they have so far, but that outperformance should continue. So it's more about lightening up on things like stocks and moving them into precious metals, more than actually selling gold as such, because that's not really something that you can ever do and, come out on top in the long term.
And I think it's also, I think that makes perfect sense what you've just said, but it's also when we get to the other side of this, we will be very strongly beating the drum. We become ultra bullish in that environment and say, well, these are the assets you need to really consider here. And you can't listen to anyone who's only ever telling you it's going to go up over the long term. So we are trying to provide a little bit of extra value there to say, well, there are periods where it's a no-brainer to go and really invest in the market. And there are periods where it's really difficult. And if we're saying it's really difficult and we're watching it all the time and looking at all these different aspects to put together, then it's probably pretty challenging for people who are new to it. So
spot on.
We're just trying to provide that. Yeah.
That's right. That's right. There are periods when it's an absolute no-brainer, back up the truck. And then there are periods where you got to be a little bit more cautious. And the periods where you got to be a bit more cautious, like we said, they don't matter if you're looking at a 10, 20-year time frame, but if you're looking at a 2 or 3 year time frame, in the midterm, it does make sense to pick those timings quite well. Still average in smaller amounts at, periods where it's a bit more complicated, but then average in larger amounts in periods where it's a no-brainer. People, unfortunately, tend to do the opposite.
They certainly do. We've got a long history here of seeing people do that. Come and do exactly the opposite of what they should do, buy at the very top and panic and sell at the bottom. But hopefully we're breaking through to a few people so they don't make those same mistakes. Look, always appreciate the updates on this. I know people are following along very closely. I had some great conversations with people down in Sydney at the Oz CryptoCon asking about the land cycles and how it's all fitting together. So I know it is making a difference to people. So thank you for your work on that, Drew. Everyone really appreciates it. Thank you for that.
Thanks so much, Chris. Good to talk to you.
Great to talk to you. Thank you everyone for watching. We'll chat again soon.